Jackson Hole was last Friday, and during that we saw Powell speak, and during Powell's speech there were a lot of words said, and you want to know probably what any of those words mean, so I've summarized everything. I boiled it down to 10 key points, and really wanted to focus on also how the mandate or how the Fed is approaching things is going to change going forward versus how it's been handled, and how that could affect the market here in the near term. So the top 10 points that Powell listed during his speech: jobs slumping, so we saw payrolls plunge down to roughly around $35,000 a month. That means the economy could be slower. You could see some slower growth there. However, the labor market was roughly balanced. So overall, you saw a balanced labor market. And again, I'm trying to summarize what was said and at least present it to you guys in more of a attainable way of understanding. Demand and supply for workers both really slowed, implying that there could be rising downside to employment, risk in general, or risks. So that's an economy risk, and stocks, it's dovish because of how the Fed will handle that. So when things sound bad, it's actually kind of good, depending on how you look at things. Because if the economy's poor, the Fed has to kind of ease the brakes on being how tight they are, right? So that's a higher unemployment risk for the market right now. Inflation's still above 2%, so that's our third point. We're seeing consumption prices still pretty high. The economy's seeing higher costs in general. And housing inflation is still, or I should say is falling, while goods inflation is positive. So that leans a little more hawkish. But at least something you want to keep your eye on. I mean, getting back to 2%, which has been the benchmark, isn't really going to be attainable in the near future, but we're going to get to that in a little bit here. Fourth point is going to be the tariff effects. So higher tariffs are lifting the prices of goods. It's making things more expensive. I don't think anyone's going to really debate on that. However, the effect of this could be seen long term. We'll see. Temporarily speaking, on the economy, this is affecting everything. It's making things cost more money, which again leans more dovishly. So you understand how these things sound bad, but it means that things could be good, because it could mean that the Fed has to not be so tight on the economy with its rates, and it wants to ease rates to make it easier for people to breathe. That, however, doesn't help inflation. So it's a big tangled mess. But how you interpret this information, bad news is good and good news is bad, really, as it pertains to the Fed. Inflation risk, so that's your fifth point. Tariff-induced inflation could cause a wage price spiral, essentially. Powell said this is unlikely just because of how labor is sitting right now. I argued that this point was kind of saying that the economy had inflation potentially contained. Consequently, that is a hawkish point, right? That one's up for debate. You guys may differ on that opinion, but that's kind of how I see it at that point. The fifth point is the anchored expectation. So long-term inflation expectations remain well anchored around that 2% point. We talked about that earlier, and that's been the goal, essentially. The economy is trying to show price stability, and you could deem that more as a dovish point than a hawkish point. And for a lot of these, I wouldn't really see things as overtly dovish or overtly hawkish, with the exception of like one or two things, but more of like kind of open to interpretation. It kind of depends on how your macro view is, combined with the view of everything else. So depending on your viewpoint, your opinion could vary on this. And you could let me know down in the comments or right now how you feel about that. But your opinion may vary on some of what I'm saying here. I'm just trying to distill what was said and kind of make it more attainable for the everyday man. That sixth point is that there's no lingering shock. So remember when you had I mean, how could you forget? Remember when we had COVID and the pandemic? The Fed is apparently no longer going to let a one-time price jump be persistent with inflation. I deem this as hawkish. This is debatable. So theoretically, if we had another, at least based on this in a nutshell, right, in a vacuum, if we had another COVID event happen next month, the Fed could cut rates aggressively or pop them or raise them, whatever they got to do, right? They could raise them high or drop them, or if we had some sort of shocking economic event is the point. Don't want to say COVID as an example. We had some sort of shocking economic event. The Fed could react violently to said event without the idea of working on containing it long term. Meaning, we're still dealing with the effects of COVID, and the Fed's going to say, okay, remember that COVID thing? Get it out of here. We don't care anymore. We're just looking forward. And they're just going to continue looking forward. So, depending on your viewpoint, you could see why that could be troublesome. But in general, the Fed's just going to continue to look forward as it sets policy and not let a one-time price jump give off persistent inflation to the market, or to the economy, I guess I should say. Seventh point is balancing the mandate. So near-term risks are now tilted toward higher inflation and weaker jobs. The Fed must balance its dual mandate as a result. This is more neutral. The economy is just cautious right now. Everything is saying cautious. What makes me cautious personally is when we get economic data from the government, they go ahead and revise it like 2 or 3 months later. That doesn't make me too confident because it's like, how can you even trust this information? But I digress. The ninth point is its policy stance. So right now, the Fed's policy rate is 100 basis points closer to neutral than it was about a year ago. So stance is essentially restrictive, but may warrant adjusting if the outlook shifts. So essentially what that means is the economy is looking to ease policy, so cutting rates, right? So it's dovish, right? The Fed is saying, hey, we're probably going to cut rates because of how this is looking, but that can change, right? So it's very, again, the no lingering shock thing, it's looking forward. So if data changes looking forward, we might, again, we're forgetting everything in the past because that's how we're moving now. Looking forward, if data shows that things need to be changed right away, then they could. And lastly, the framework update. And this is what I really want you guys to home in on. And essentially, this is what I'm going to zoom in on here. The Fed is going to return to its simple 2% inflation target. This is different from when we had COVID and the 2020 era kind of stuff. We're dropping the prior make-up overshoot strategy. So this is hawkish, at least in my opinion, mainly for stocks reacting more to the downside on this framework update. And the economy is going to be more inflation focused. So in my opinion, it's could be better for the economy. I guess that's to be seen. It's very debatable. Here's why. And I'm going to break down again this framework piece. So there's no more makeup rule. The makeup rule was previously if inflation stayed below 2% for a while, the Fed let it run above 2% later to balance out. So they allowed an overshoot to allow inflation to balance out either which way. So they said, hey, if we're under, then we're going to let it run under. And if we're over, we're going to let it run over as long as we anticipate it coming back to where it should be. Remember, inflation is transitory. That was kind of the idea at that point in time. So now we're going to skip that and just aim directly at 2% without catching up with the past misses. So if we're over, we're under, we don't care. 2%, that's the goal. So you could see why that could be problematic, and it could also be a good thing, kind of depending on how you feel about the economy. This leads into systematic targeting. So you're treating the risk of inflation being too high or too low equally. So it's more balanced in that response, or in that regard. You're not really favoring one side of being like more that inflation's too high or inflation's too low. You're looking at it really more pragmatically and more short term, which again, depending on your opinion, can lean more good for the economy or bad for the economy. It really kind of depends on you and your overall opinion. There's less focus on the lower rate trap. So the old rules that we had about worrying about situations when rates can't go lower, and this is called the effective lower bound, by the way. Now they downplay that to cover more scenarios. So I guess you can call that caution. And lastly, the framework update. And what's different about the framework update is this is allowing for quicker action to be possible. So the Fed can now raise rates faster if inflation hints at rising, even without the full proof. So even if the Fed feels like, oh, we could be having rising rates again, we could see rising inflation again, we're going to raise rates right away, even though the data's not fully there yet, they could theoretically do that with this like new framework. So that's something you want to keep in the back of your mind, especially as an investor. So I want to kind of hone in and compare the old one to the new one. And I have this kind of distilled down again to make it more easy to understand. So the old framework allowed for temporary higher inflation. So again, I want you to think back to COVID, how things were all out of whack, supply chain, everything was all out of whack, right? That old framework allowed for higher inflation after low periods to average out around 2% over time. That was the goal, right? We're going to allow it to go higher if it needs to go higher because we're only seeing it as short term. Remember, inflation is transitory, right? So we focus mainly on fixing the job shortages because the logic at that point in time is if we fix the job shortages, then we will fix inflation. That was at least the thought process. And it was designed for times of weak growth and lower inflation. So this essentially led to lower rate hikes during that 2021, 2020, again, that whole COVID-y time. The new framework is not allowing for averaging or makeups, right? We're not making things up. We're not allowing inflation to run high. We're not allowing it to run too low, whatever the case may be. It's going to be a little bit more strict, balancing jobs and inflation goals more evenly. So we need to look both at the labor market and where inflation is and make logical decisions based off of that. So this watches for the job markets getting too hot, which eventually could spike prices theoretically, and will act sooner. Overall, it is more of a stricter way to look at inflation risk while still supporting jobs and making the Fed less likely to keep rates too low for too long in high inflation times, which is very interesting. So you could see how this new framework can be better for the economy. The issue is we didn't resolve our issue. So this, in general, if we didn't have the lingering effects from COVID, and this is my opinion part, right? If we didn't have the effects from COVID, this is actually not a horrible policy. It makes sense. It's very pragmatic. It makes logical sense, at least in my opinion. However, we haven't fixed the problem. So now we're just taking the problem. We're going to be like, all right, we're going to take this cancer of a problem and we're just going to kind of deal with it and just kind of hope it goes away as we continue to pretend like it's not there. That's where the issue lies, at least in my opinion. Now, obviously, September, the market is essentially priced in a Fed cut, right? That could obviously happen. It may not happen. It could happen. It probably is going to happen. My question to you is that rate cut already priced in? We saw a hard pop on the IWM on that Jackson Hole speech last Friday, which is the index you want to watch as it pertains to for that Fed cut to come through, because those smaller cap names, as those interest rates drop, they're allowed to borrow money for cheaper, refinance debt. They have a stronger ability to last longer. These growth names can actually grow because they can borrow money and get cheaper money that allows them the opportunity to get even bigger, right? That's good for them. So you want to watch the IWM to get an idea of how the market is reacting to Fed policy, again, at least in my opinion. So you saw a strong reaction there, and obviously that reaction carried over to SPY as well. My question to you guys at home is this potentially front-running, I guess I should say, that Fed cut rate? And I want to harken back to this date right here on the 12th of August, where we got our first whisperings of a Fed cut, at least more like confirmed. It was at that point, I believe it was priced in at 100%. Now that dipped to like 80 or something in this little retrace, and now we're back at like high 80s. But we had that first move happen when the IWM was sitting around 221. So we're 12 points higher. Is it possible that from that point in time, the move could be baked in? And especially if we continue going higher, is that pop that is typically seen when the Fed goes from a raising rate environment to a cutting rate environment, is it already baked in? That's my question for you, and that's for you to ponder. My opinion, if we get and we continue to move higher here, especially into September, I would lean and err on the side of caution and say yes. If we get a back trace here, especially if we move south of 221, then I would lean on the side of no, it wouldn't be priced in. But the higher we go, the higher at least in my opinion, near term, the higher we go, the higher the odds of that move already being baked in. Now, I want to leave you guys with this. The Federal Reserve's updated policy appears sustainable because it promotes more balance, right? As I alluded to, it's a better way of how we should look at inflation and handle inflation, but it didn't forgive the past, right? Preemptive responses to inflation and employment risks across diverse economic scenarios, essentially, this will reduce the likelihood of prolonged imbalances. So essentially what I'm trying to say here is these preemptive responses to inflation and to employment, no matter what the scenario is a better way to move forward, so we don't have a 2021, 2022 kind of thing. However, this doesn't clean up the mess from the pandemic, though. So that's my whole take on Jackson Hole and what we're kind of doing right now. Now, this week's a little bit of an interesting week. We're coming off the reaction of that big move from Jackson Hole. We're coming off of, or I'm sorry, we're heading into a holiday week with Nvidia's earnings in the middle of the week. So for me, at least the way I'm looking at the market, we're not out of the woods either which way. Not a bull, not a bear, but this is definitely a time, I think, to be risk off on the market. But let me know what you guys think about Jackson Hole. Let me know what you think about the market right now down below.